If an entity performs by transferring goods before the customer pays, it records a contract asset, a conditional right to consideration. If the customer pays in advance, the entity records a contract liability, an obligation to perform. This flowchart illustrates the 5-step model. It serves as the central algorithm used to execute revenue recognition across all contracts, regardless of the industry or transaction type. By moving to this step-based model, revenue recognition transitions from a broad matching principle to a structured, auditable assessment of the customer's ability to direct the use of an asset. Step 1 initiates the algorithm: identify the contract. A contract only exists under IFRS 15 if it meets 5 mandatory criteria. The parties must have approved it. Rights and payment terms are identifiable. The contract has commercial substance, and it must be probable that the entity will actually collect the consideration. Step 2 requires the entity to identify the performance obligations. This is an unbundling process. Complex deliverables must be deconstructed into their atomic units of delivery. To unbundle a contract, you apply a 2-part test to determine if a good or service is distinct. The customer must be able to benefit from the good or service on its own, meaning it is capable of being distinct. Additionally, the promise to transfer it must be separately identifiable from other promises within the context of the contract. This split-screen logic tree breaks down a practical example: a $120,000 corporate contract containing both a primary software license and 1 year of technical support. The bundled package passes through the distinct test and separates into 2 obligations. The software and the support pass the test because the customer can use the software without the support, and the entity is not providing a significant integration service that inextricably links the 2 together. This unbundling requirement prevents companies from front-loading revenue on long-term service contracts. By isolating each specific obligation, the timing of revenue recognition matches the exact timing of delivery to the customer. Step 3 is determining the transaction price. This equation isolates the consideration the entity expects to receive. It must exclude amounts collected on behalf of third parties, like sales tax, and be adjusted for any significant financing components or consideration payable back to the customer. Contracts often include variable consideration, like performance bonuses, penalties, or discounts. This variability must be estimated using either the expected value method for a range of probabilities or the most likely amount method when there are only 2 possible outcomes. But there is a crucial constraint. Variable consideration is only included in the transaction price to the extent that it is highly probable that a significant reversal in cumulative revenue will not occur when the uncertainty is eventually resolved. This calculation matrix demonstrates the expected value method. If a contract has a $100,000 base fee plus a 60% probability of achieving a $20,000 bonus, the calculation yields a constrained expected value of $112,000. This constrained probability-weighted expectation defines the transaction price, which can result in a figure significantly different from the maximum potential contract value. Step 4 requires the entity to allocate this transaction price to the specific performance obligations identified in Step 2. This allocation is done proportionally, based strictly on the relative standalone selling prices of each obligation. If a standalone selling price is not directly observable in the market, the entity must estimate it. This is typically done using an adjusted market assessment, an expected cost plus a margin approach, or in highly variable cases, a residual approach. Looking at this data table, we can execute the mathematical allocation for our previous software example. The estimated standalone selling prices are $90,000 for the software and $30,000 for the support, a 75 to 25 split. We then apply those percentages to our constrained $100,000 transaction price, yielding $75,000 allocated to the software and $25,000 allocated to the support. This pro rata allocation ensures the revenue attached to each deliverable perfectly reflects the standalone economic value of what the entity is actually transferring to the customer. Step 5 defines the ultimate trigger for revenue recognition. An entity recognizes revenue when or as it satisfies a performance obligation. That final satisfaction occurs precisely at the exact moment the customer successfully obtains control of the underlying asset. Control transfers in one of 2 ways. It can transfer over time if the customer simultaneously receives and consumes the benefits, if the entity creates an asset the customer controls as it's built, or if the asset has no alternative use to the entity and the entity has an enforceable right to payment. If recognized over time, progress must be measured consistently. Entities use either output methods, like surveys of milestones reached, or input methods, like costs incurred relative to total expected costs. This timeline graphic maps out the two recognition paths. If the criteria for Path B's over time recognition are not met, the obligation defaults to Path A, point in time. Indicators for this exact point include the transfer of legal title, physical possession, or passing over the significant risks and rewards of ownership. With Step 5 satisfied, the core algorithm is complete. The abstract promises of a legal contract have now been successfully converted into crystallized, measurable, hard revenue figures. Beyond the core algorithm, the standard dictates the treatment of contract costs. Incremental costs of obtaining a contract, like sales commissions, must be recognized as an asset and amortized if the entity expects to recover them. In contrast, general costs to fulfill a contract that do not enhance resources for future performance must be expensed as incurred. Product warranties also demand specific categorization. An entity must determine if it is offering an assurance-type warranty, which merely guarantees the product complies with agreed-upon specifications, or a service-type warranty, which provides an additional service or is purchased separately. This split logic tree tracks the accounting routes for warranties. Assurance warranties are handled strictly as liability provisions under IAS 37. Service warranties, however, provide a distinct benefit and must be unbundled, routing back into the IFRS 15 algorithm as separate performance obligations. Strictly categorizing secondary promises and acquisition costs forces these components onto a defined recognition schedule, limiting the ability to front-load or defer income without specific technical justification. Determining who holds control becomes complex when third parties are involved. The principal versus agent test asks one defining question: does the entity control the specified good or service immediately before that good or service is transferred to the customer? This classification dictates the top-line reporting. Principals recognize the gross amount of consideration, while agents report only the net fee or commission they retain. Similarly, physical possession does not always equal control. In a consignment arrangement, a dealer has physical possession of inventory, but the supplier retains control and defers revenue. In a bill and hold arrangement, the entity retains physical possession, but the customer has gained control, allowing the entity to recognize revenue immediately. Physical location is largely irrelevant under IFRS 15. Only the legal substance of control dictates when revenue actually hits the books. The standard also accounts for transactions designed to unwind. For example, repurchase agreements, like forwards or call options, negate the customer's ability to direct the use of the asset. The customer does not have control, forcing the entity to account for the transaction as a lease or a financing arrangement instead of a sale. A sale with a right of return operates on a similar principle of restraint. An entity can only recognize revenue for the products it mathematically expects will not be returned by the customer. These three T accounts map out the mechanics of a return. When control transfers, the entity records a credit to revenue for the goods expected to stay with the customer. The remainder goes to a credit in a refund liability account. Finally, the entity debits a right to recover asset for the inventory it expects to receive back. The framework proactively accounts for its own potential unwinding. It ensures the balance sheet never overstates certainty when a transaction is still reversible. The culmination of this data requires extensive disclosure in the financial statements. Entities must provide qualitative and quantitative information, most notably disaggregating revenue into specific categories that depict how the nature, amount, timing, and uncertainty of cash flows are affected by economic factors. This balance sheet graphic traces the journal entry lifecycle. When an entity signs a contract and receives an advance payment from a customer, it recognizes the cash and immediately records a contract liability, representing the obligation to perform. When the entity satisfies the performance obligation by delivering the software and transferring control, it debits the contract liability to clear it and credits revenue. If the entity performs first, it debits a contract asset, a conditional right to payment, and credits revenue. Once only the passage of time is required before payment is due, that conditional right becomes unconditional, shifting from a contract asset into a standard receivable. The IFRS 15 algorithm provides a standardized protocol to translate complex, multi-layered legal contracts into the discrete line items of a financial